Welcome to the Deep Dive. Today we're jumping right into really a case study of extreme market skepticism.
Yeah, this is a good one.
We're looking at Alpha and Omega Semiconductor, that's ticker AOSL. This is all about their fiscal Q1 2026 results that dropped back on November 5th.
And the reason we're diving in here is because of this just shocking disconnect between what the company reported and how the market reacted. It was violent.
Absolutely. The mission here is to figure out why a solid earnings report led to a complete and utter meltdown in the stock price.
Exactly. I mean, if you just glanced at the headline numbers, you'd think, okay, pretty good. But the stock fell off a cliff. We're talking a devastating 27.5% drop from before the call to the next day's close.
So something in that guidance, in the forward-looking story, was enough to wipe out nearly a third of the company's value. Just like that.
Let's figure out what it was.
Okay, so let's start with that rear view mirror, because you're right, it didn't look like a disaster at all. Revenue came in at what, $182.5 million?
Yep. Correct. Which was up a tiny bit year over year, up a little more sequentially. But, it was right in line with our own guidance. So no big surprise there.
The real surprise was on the bottom line, the profitability.
That's where the beat was. Non-GAAP EPS, earnings per share, came in at 13 cents.
And consensus was closer to 10 or 11 cents, right?
10 to 12, yeah. So hitting 13 cents was a material beat. I mean, for some analysts, that's a 30% beat. That kind of number should be rocket fuel for a stock.
And for a second there it was. We saw that little knee-jerk reaction in after-hours trading. The stock popped up, 3%?
Yep. People just saw the EPS beat and clicked buy.
But that spike was very short-lived.
To put it mildly, as soon as the actual guidance hit and people started reading the transcript of the call, the whole narrative just flipped.
Wow.
I mean, a 27.5% collapse in one day isn't just noise. That's a fundamental repricing of risk. This stock's average move after earnings is usually around 9, maybe 10%. This was almost 3 times that. The market basically screamed that its entire valuation for AOSL was wrong.
So the good news was completely erased by what's coming next. Before we get to the pain, let's talk about the story management was trying to tell. What was their big strategic vision on this call?
Well, they really doubled down on this idea of a transformation. They're trying to shift their whole identity from just, a component supplier.
Selling parts.
Right, just a parts vendor, to becoming a total solutions provider. And they're doing that by packing more of their own power ICs and controllers into their products. It's a classic move up the value chain.
And based on the Q1 numbers, that part of the story is actually working. Their power IC revenue hit a record, didn't it?
It did. A record $72.7 million. That's a huge 37.3% jump from last year, and it now makes up almost 40% of their total product revenue. That's a really positive structural shift in the business.
And they got the cash to fund it now.
That's the key. They just got the first big check, about $94 million, from the sale of their China joint venture stake. So this isn't just operational cash, this is strategic cash.
So the big question is, where's that $94 million going? Is it just sitting on the balance sheet?
No, they were very clear about it. It's dedicated capital. They said it's being funneled directly into new technology, more capacity equipment, and critically, hiring more system-level engineering talent.
And they're targeting some big markets with that talent. Graphics cards, smartphones, AI platforms.
And that's where it gets really interesting. They basically hung their entire long-term story on aligning with the very, very top end of the AI world, specifically with NVIDIA's new power architecture.
The 800 VDC architecture.
That's the one. They're positioning themselves for this massive shift to the 800-volt direct current architecture that's needed for the next generation of AI data centers. It's a huge technological leap.
Okay, hang on. For anyone listening who isn't a power semiconductor analyst, can you just quickly break that down? Why is 800 VDC such a big deal? And why does it open up, as they said, fresh sockets for a company like AOSL?
Sure. It really just comes down to efficiency and heat. When you're cramming more and more power into an AI server to feed these incredibly hungry new GPUs, traditional silicon chips just can't handle it. They get too hot, they waste too much energy.
Right.
The 800 VDC architecture demands new materials, specifically silicon carbide, or CC, and gallium nitride, GNL. These are what are called wide bandgap materials, and they can handle way more power and higher frequencies with lower losses than old school silicon.
So because the whole industry has to move to these new materials, the old chips become obsolete.
Exactly. It levels the playing field. AOSL isn't trying to steal a spot from an incumbent. They're designing the power solution for a brand new standard. That's what they mean by fresh sockets. Performance is everything, not just saving a few cents. And for their 2027 vision, that's an incredibly powerful story.
It is a powerful story. But let's be realistic. Every semiconductor company is talking about AI right now. How unique is this 800 VDC play for them?
That's a great question, and it's probably where a lot of the market skepticism comes from. The technology is real, but the market wants to see the actual design wins. Management is betting big that their investments will land them those key platform spots, but they have to execute perfectly. It's an execution risk story now.
And we have to bring this back down to earth for a second. We talked about the 13-cent non-GAAP beat, but that's with adjustments. On a pure GAAP basis, they're still losing money.
That's the necessary asterisk on all this. GAAP EPS was actually a loss of 7 cents, a net loss of about $2.1 million. And while that's better than last year, the market gets very nervous when a non-GAAP beat comes mostly from excluding costs that are still real.
It kind of reinforces the idea that the underlying business, despite the great power IC growth, still isn't structurally profitable.
Not yet. And that lack of real profitability just ratchets up the tension as you head into the guidance.
Which is what caused the 27.5% sell-off. So let's look at the numbers they reported in Q1. Where was the strength and where was the weakness?
Well, the computing segment looked really strong. It was over half their revenue, up 27% year over year. But management immediately put two big caveats on that.
Let me guess. Seasonality and tariffs.
You got it. Customers basically pulled in orders, buying inventory early, so that strength was borrowed from the future.
Right.
Communications was also up, but that was driven by a new smartphone launch. Again, event-driven. Meanwhile, the weaknesses looked more structural. Consumer revenue was down almost 26% year over year.
Home appliances, gaming, cooling off.
Yep, and their power supply and industrial segment was down over 12%. So the weak parts of the business are cyclical, while the strong parts were temporary. That's a very worrying setup.
And that perfectly sets the stage for the guidance trap. They did $182.5 million in Q1. What did they tell the market to expect for Q2?
They guided for a revenue of only about $160 million, plus or minus $10 million. That's a massive sequential drop. We're talking like a 12% step down from one quarter to the next.
Ouch.
And it wasn't just the revenue, it was the margins.
Which is where that whole strategic pivot is supposed to pay off. Higher end products should mean higher margins.
And that's where the story fell apart. Management guided for non-GAAP gross margin to compress down to 23.0%. That's down from 24.1% in Q1. Now, a 1% drop might not sound like much.
But for a company struggling to hit GAAP profitability, it's a huge red flag.
It's a huge red flag. It tells the market that the strategic growth in power ICs isn't happening fast enough to offset the cyclical decline in their older, lower margin stuff. It directly challenges their whole transformation narrative.
And when they were asked why things were slowing down so much, what was the excuse for AI and graphics?
They use the term digestion phase.
The classic digestion phase. Code for it's delayed.
Exactly. It means the big benefits from those new 800 VDC ramps are being pushed out. They said they now expect things to normalize in calendar 2026. So if you were an investor hoping for an immediate AI catalyst, you just got a 6 to 12 month delay notice.
So to sum it up, they offered a 2027 vision, but confirmed immediate cyclical pain, worsening margins, and a near-term AI delay.
It was an instant repricing event. It forced investors to stop valuing the stock on its long-term story and start valuing it on its really weak near-term earnings power. And the execution risk just went through the roof.
The analysts reacted pretty much immediately, right? We saw some big downgrades.
Oh, yeah. The sell-side support just evaporated. B. Riley, for example, they cut their rating from a buy all the way down to neutral and chopped their price target almost in half, from $40 down to $24.
Wow. That's a massive revision.
It's a signal that they have fundamentally lost faith in the company's ability to execute in the near term.
And we should remember, this stock was already having a rough year. It was down 45% year to date, while the broader semiconductor index, the SOX, was up big.
Yeah, this wasn't happening in a vacuum. There was already anxiety about them lagging the sector, and this call just confirmed everyone's worst fears.
And what about the regulatory stuff? They had that settlement over Huawei shipments. Did that play a role?
I think it added to the noise. They settled the case for about $4.25 million. And while settling is good, it just reminds investors of the elevated operational risk they have, especially around their China business. When people are already nervous, stuff like that just fuels the sell-first mindset.
So management is out there saying, Steady growth through 2026, big upturn in 2027, and the market is just not buying it.
Not at all. The market has decided that the gap between today's problems and that 2027 promise is just too wide and too risky. The price action is telling you the story might be real, but the timing is completely uncertain.
They did try to throw a lifeline to the stock, though. They announced a new buyback program.
A $30 million share repurchase authorization, which is about 5% of their market cap. It's a strong signal, especially since they have that $223 million in cash. It says management thinks the stock is a bargain down here.
But it hasn't worked so far.
Nope. The stock is still completely depressed. It proves that right now, even a big buyback can't overcome the deep skepticism about their guidance and execution. The market is betting against the buyback.
Okay, time for our favorite disclaimer. This is not financial advice. We're simply taking the facts from this deep dive and exploring an outrageous but plausible trade idea that emerges from all this chaos.
Right. And the premise for this trade is pretty simple. The stock is oversold by a factor of 3 compared to its normal volatility, and management just put a tactical floor under the price with that $30 million buyback backed by real cash.
So you're thinking this is a classic snapback, mean reversion kind of trade.
That's the idea. The outrageous part would be to buy some long-dated, deep-in-the-money call options, maybe 6 to 9 months out. You aren't betting on the 2027 AI story coming true tomorrow. You're just betting that the panic selling is overdone and that the $30 million buyback is going to create enough of a bid to cause a technical bounce off this insane negative 27.5% drop. You're trying to capitalize on a temporary pricing anomaly.
So the bet is that the buyback cash gets deployed faster than the market's patience runs out. The big risk is that Q2 is even worse than guided, or they're slow to actually buy back the stock and that floor just drops out from under you.
Precisely. It's a high-risk gamble against sentiment, purely based on management's signal of confidence with their own cash.
Okay, let's pull all this together for you, the listener. The key takeaway here is this deep, deep split. AOSL has a really compelling long-term vision. The power IC pivot is real, the 800 VDC AI story is exciting, and they have the cash to do
The
it.
immediate future is just clouded by these steep guidance cuts, the margin pressure, and that unexpected digestion phase for their AI products. And that's led to this intense market skepticism around their ability to execute.
The market is basically forcing management's hand now.
Yep. They have to prove that the money from that JV sale wasn't just to buy time or prop up the stock, but that it's going to deliver real platform-level design wins in the next, say, 6 to 12 months.
Which leaves you with a final provocative thought to mull over. Which one's going to show up first? That promised stronger structural upturn in 2027, or another round of execution risk and proof that the cyclical downturn is going to last a lot longer than anyone thinks?
It's a great tension, and if you want a hint, keep a very close eye on how quickly they actually deploy that $30 million buyback. That'll tell you everything you need to know about their real conviction.
Thanks for diving in with us. Now go form your own conclusions on whether that strategy is worth all this short-term pain.